For those of you who are newer readers, the first $100,000 was a concept from Charlie Munger. At an old Berkshire Hathaway shareholder meeting, back from the 1990s I think, a young guy asked Munger for the most intelligent financial advice he could give him. This was towards the end of the era when Buffett and Munger would say very specific things at the Berkshire meetings, as opposed to the "I don't know you and your circumstances and can't tell you how to live your life, so just try to learn what you can and get a little bit smarter each day" that has become the default response to such questions in recent years. For a while, Munger would give the explicit advice. The first $100,000 is a bitch, but you gotta do it. And then he would go on to say, my paraphrase from memory, "I don't care what you have to do if it means walking everywhere and not eating anything that wasn't purchased with a coupon, find a way to get your hands on $100,000. After that, you can ease off the gas a little bit." The logic was that $100,000 is the mark at which your money really starts working for you. To fast forward Munger's advice 2 decades, it might be more appropriate to use $150,000 as the figure. Either way, you can see how you're latching yourself onto a rocket ship once you hit the 6 figures. A $125,000 portfolio yielding 3.3% is making $343 per month, which you get just for staying alive another 30 days. If the dividends grow by 7% across the portfolio and you are reinvesting the dividends, those $343 monthly checks will be turning into $378 checks this time next year without you adding anything. Then, they'll turn into $416 2 years from now. 3 years from now, they will turn into $458 monthly checks. It's a self-propelling thing. In Munger's early years, he had a strong desire for both current income and capital appreciation. In practice, this led Munger towards high-quality real estate as well as stock investments. Munger's desire to get rich while he could still enjoy it led him to selectively take on debt to back his best ideas. This decision, by the way, is a marked contrast to Buffett. To put it bluntly, Buffett hated debt and in early 1970s interviews would often compare high debt to an economic form of slavery, arguing that intelligent men and women should be able to find a way to become rich without the use of leverage. First and foremost, Munger sought immediate income to fund other investments. In much the same way that Berkshire Hathaway uses its dividends to fund acquisitions of firms, Munger was eager to find dependable sources of income that would fund other investments. In his case, he developed real estate and used leverage to buy undervalued stocks, such as Canadian power companies with stable dividends high enough to service the payments on his debt. The take-home lesson, by the way, is not that you need to employ debt to succeed. Rather, it's the fact that Munger saw the dependable generation of cash, whether it be dividend income or rent income, as something inextricably tied to the creation of wealth through capital gains, i.e. buying undervalued stocks and selling them after favorable price movement. Charlie Munger structured his business life in such a way that he acquired cash-generating assets so that he could always have money coming in to buy other undervalued assets, which were often cash-generating as well. Although Munger has never labeled himself a dividend investor, it was his ability to always have streams of cash coming through the door that enabled him to make capital appreciation investments. By the time Munger opened his fund, which, by the way, generated 19.8% annual returns from 1962 to 1975, he had resorted to openly mocking those who worried about lower stock prices. Even though many of his individual and fund holdings fell by 60 to 75% during the bear market crash of 1973 to 1974, Munger did not engage in any panic selling and, in Janet Lowe's book, mentioned that the thought of selling out never crossed his mind at any point in his investing career. What I find useful is keeping in mind why Munger was able to be this way. Although his portfolio holdings fell dramatically during the 1973 to 1974 crash, he did not flinch because at this time, he had monthly income coming in from an Amoco oil partnership, real estate, and some high-paying dividend stocks to satisfy all of his personal needs. By having an income-generating foundation, Munger was able to put up with the wild fluctuations that often accompany the pursuit of investing for high total returns.